how we make the investment readiness fund and the investment process in total actually a reality in Greater Manchester. We've got two really good speakers. Jamie Mansfield, who's co-director of environmental finance, and Matt Ellis, who works with me at the GMCA and is the cabinet liaison officer, who's going to talk a little bit about the Ignition project, which was mentioned in the front room. I'm going to try and keep the speakers to about 25 minutes. Is that okay?
25, is that the...
I'm 75, so
whatever. So that will leave us at about another 25 minutes for questions. I do have to give feedback to the main session later on based on the outcomes from today, this morning session and this afternoon session. So if you're all really quiet and don't say anything, I've got problems. So I would encourage you to be vocal and to do engage. I want to try and prime that by saying at the end of the presentation there are 4 questions that we're going to ask. So I'd like you to hold these in your mind as you hear the presentations. What are the potential sources of co-funding for the Investment Readiness Fund? How should we evaluate investee projects? Who needs to be involved in the Investment Readiness Fund setup and governance? And what role should GMCA take in the Investment Readiness Fund? So they're the 4 questions that we're going to try and answer at the end of the presentations today. Any questions? Lovely. Jamie.
Great, very nice to be here this morning, and it was a bit of a trip up from London, so I'm amazed that we made it through snow. So just firstly, a little bit of background about environmental finance and what we do in the environmental space. So environmental finance is a form of investment boutique, and we offer advisory services, and we work with organisations like RSPB, National Trust, WWF, as well as public sectors, DEFRA, Welsh Assembly Government, and also recently GMCA through the work we were supporting FTEC in creating that natural capital investment plan for Greater Manchester. The other side of our business is a fund management side, and so we actually run impact funds, and that really is our specialism. So we have £53 million of impact investment, and core is a community-owned renewable energy fund, so that's all about facilitating the transition of renewable energy assets into community ownership, and we do that with a blended structure, so we have investment capital and grant capital that we deploy into projects. And Picnic, which is the world's first urban green investment firm, and we're basically investing in community-scale enterprises within parks to create revenue streams to ultimately support the running costs of those parks. And we're doing this as part of the Future Parks programme, working at the moment primarily in Newcastle. That was the first sort of city that's been chosen through that, with National Trust and HLF, Heritage Lottery Fund. So that gives a bit of a taste as the types of sets of skills that we bring. So we really bridge the gap between the conservation world and the investment world, and primarily our team is made up of individuals that have come out of either the city, accounting, engineering, and bringing that sort of expertise to the sector. So what do we mean by natural capital, and what's the sort of the state of the market, and what are we trying to achieve with an investment readiness fund? So firstly, the really important point, and I think it was illustrated quite helpfully in the first session, was that investment, what we're talking about is not just about grant funding. We're looking at projects where there is a cash flow that we can finance against. So it will deliver both the capital that you invest in the project to make it happen, but also a surplus, a return or a profit within a known time frame. And that's a really important differentiation. So we're not looking at projects or where there is no source of return out of them. And then if you look at the sort of the state of the market, and we look at this in terms of an hourglass type approach, and so at the bottom we have a whole group of projects that are looking for capital to be deployed, and then we've got investors looking down, going, how do we put money into these projects, and how do you actually deploy money through these projects to make them happen? And in reality, in terms of where we are today, we're at this intersection. There's a very small amount of projects which actually are able to transact and actually sort of transact with that capital and allow investment into them. And there's a whole range of reasons behind that, to do with the the sort of revenue structures, the business cases, the risk profiles of those. And what the Readiness Fund is trying to achieve is trying to broaden this intersection. We're trying to increase the number of transactions that can happen within the market. So you're trying to increase the volume of projects which can actually seek and transact with investment capital. So what is the sort of broad purpose of Investment Readiness Fund? So if we look at today in the sort of conservation world, typically we have lots of charitable organisations which their primary source of income are through grants and donations. And that's how they deliver their main natural capital services. And what we're trying to achieve is a way for them to move into enterprise or trading models so they can then scale up those activities and deliver more natural capital than they would be able to deliver with just the grant-funded model. And so what an investment readiness fund is trying to achieve is to shift them over into that sort of broader approach and make them more into a, as I said, sort of a trading structure. And it's those trading models that can then raise investment, and it's those trading models which then you can invest against and build up to scale up the impact of these projects. So how does an IRF actually work, and how does it sort of unlock the issues to scaling up these projects? Now, the first thing is that an IRF is not just about deploying money. It's actually about deploying skill sets into these organisations, and that's often a sort of a fundamental gap that often organisations think we just need lots of capital to build up our business models and to scale up. And actually, before they even need to start thinking about investment, they need to think about what is the core business activity that they're undertaking and how are they operating and managing that as a process. And so as we work through those barriers, such as the financial and commercial skill sets, how to understand what types of finance are available to them, let alone where they can look to actually raise that finance, it's how you address those issues, which is what the Readiness Fund really achieves. And so as we work through those points, and the Investment Readiness Fund then deploys an element of capital into the individual projects, but also the skill sets, you can then start addressing the underlying business plans for those enterprises. And that's how you can build up the investment case for these types of activities. So has this been done before? And the answer is yes. So one of a very sort of similar market, if we look into the social investment market, where in the early 2000s, that market, and predominantly still is dominated by grant-funded organisations, where you have charities and social enterprises and community organisations, where their primary income stream is through grant funding or public sector funding of some sort. And what the social investment market development showed was that in early 2000, that was sort of around it was just under £100 million of market value. And then a market study conducted by Big Society Capital in 2017 showed that actually that had grown to over £2 billion as a market. So how did they achieve that? What were the drivers that allowed that market to grow? And one of the key mechanisms which allowed the expertise, the skill sets, and the sort of the ambition of those organisations to grow was through investment readiness funds or equivalent type structures to deploy money into the enterprises to grow their capacity, their skill sets, which allows them to then build business models which can then go on and raise money in their own right. And so that is one of the key learning points that we can look at from the social investment market. And if we sort of take that approach, can we apply that to the conservation market, and can we apply that to natural capital? And we absolutely believe we can. You can see that it's a very similar issue in terms of the skills gaps and the constraints. And that means that actually, can we apply this approach to solve the problems we're seeing? So if we take some of the examples that we've seen in the social investment market and start to sort of drill into them, what can we learn out of those? So the Investment Contracts and Readiness Fund, originally funded by government, deployed £50 to £150,000 grants into organisations. Now, that money was largely for third-party advisors. It wasn't solely for the end grantees. So what that meant is that it paid for expertise to come in and help build up and develop the business plan, which could then raise money. And what that did as an approach, as you can see here, is that it turned a £13 million grant programme into over £230 million of investment. And it's that methodology that is the really key point to this, that actually we can deploy money in the right parts of businesses to grow their capacity, to grow the robustness of their business models, and it's those business models which then raise investment and scale up the impact that those organisations are delivering. Then you can look at big potential. It's a big potential breakthrough. This is a slightly earlier stage, but it's being funded by the Big Lottery Fund. So far they've deployed just over 6 million, and that's delivered just under 3 million of investment. So it's still early days in terms of the success of that programme, to work out how successful that has been. The Reach Fund, again, very similar, but what you can see is that 3 million of grants led to 17 million of investment, and so on. So you get the sort of methodology. Quite interestingly, ACRE, so Access to Capital for Rural Enterprises, which is a consortium led by Christian Aid, that doesn't deploy capital as such, but it just deploys the sort of the knowledge resource and the training into organisations to help build up those business models. Again, it's quite early stage for how that programme is working, but it's all about providing technical assistance to build up the capabilities of those underlying organisations to build their robustness and investment readiness. So if we take that learning and then we think about how we can apply that to an investment readiness fund, we then go into what could that mean for Manchester, and how could that lead into a structure. So taking the learning and the sort of the strategic direction and priorities that's been identified through the Natural Capital Investment Plan, they need to appoint a third-party fund manager. That could be done in-house, but that fund manager would then look to execute and coordinate the Natural Capital Investment Plan. And what it would look to do is to match fund potential sources of central funding, potentially looking at the UIA programme, which Matt will go on to explain later. But look at how we can match fund that with other sources of philanthropic and private capital into the fund, and deploy that money with technical assistance into the underlying investing projects. And it's this approach which allows you to build up the capacity of the underlying schemes, and it's those schemes which will then go on to raise the investment money, as Louise was talking about earlier, in terms of from an abundance position of at what point do you invest. Now, our whole point is that lots of these projects are not in a position where they can raise investment money today. We need to develop their capacity to get them to the point where they can raise investment money. Critically to this whole structure is the impact measurement, and this is about recording the effectiveness of these interventions, both in terms of the successfulness of how your money and resource has been deployed into the investing projects. So for every pound I grant in, how many pounds can I create in terms of investment, but also what is the natural capital result that I'm achieving. So am I better off giving £1 to planting trees, or by giving £1 to a business plan, can I raise £100 in the back of it to plant trees? So it's that you're trying to test as a rationale, and that feeds back into the overall structure to make sure that you refine your investment approach, and that you refine the technical assistance that you're then providing into the investees. So what are the potential sources of capital that could be delivered alongside existing sort of potential sources of capital? So potentially you could look at the landfill community tax. Is there a way that we could aggregate some of those income streams across Greater Manchester? Is there a way that we could aggregate some of the Section 106 payments? Again, looking to pull together small, discrete elements of money, but actually aggregate that into a meaningful amount of funding. And also, one of the areas that we're seeing a lot of interest in from an environmental finance perspective is venture philanthropy. So increasingly high net worth philanthropists who have quite often made their money in the city or made it out of trade and enterprise, they actually value that actually just giving away your money is not necessarily going to lead in the sort of the most impact, and that actually giving their money to enterprise models, to create impactful enterprise models, can actually deliver far more impact and far more benefit than just looking to give that capital away. And so there's a whole sort of increasing sort of movement within philanthropy around that. There's also an opportunity to engage with corporates, again using a similar approach for venture philanthropy, where organisations will look to deploy not just money but also expertise through a facility to help organisations grow their underlying capacities. And that's the approach that we're looking to achieve, to syndicate both money and skills to invest into these projects. So, very quickly at the end, just thinking in terms of where we are today and how could we turn this into reality. So very fortunately, through the Natural Capital Investment Plan, the real starting point behind any fund is the theory of change. And it's what are you trying to achieve and how is that impact going to be measured, and how do we demonstrate success through that. And so lots of those elements have started being tested and socialised through the Natural Capital Investment Plan process. And also very helpfully, initial pipeline of potential investees has started being identified, both spatially within the geography of Greater Manchester, but also in terms of the types of projects. So whether that be SUDs, whether that be place-based sort of investment trust model, as well as the sort of carbon trading models as well. And so as we build up that sort of pipeline of opportunities, we then end up with a structure that we can then start to build a business plan around, and that's really the next stage behind this, and that's to aggregate the various opportunities together and pull them into a sort of a strategic funding structure where you can then deploy the right amount of capital and expertise into those individual opportunities. And underlying that is what is the underlying financial structure that sits behind the fund to do that, and how do we measure that success, the impactfulness of the overall fund itself. And then once we have that, then we can prepare an investment memorandum and go out to seek both capital but also knowledge skills that we can bring into the fund to facilitate that investment into the underlying projects. And so as you work through that, within a sort of a 12-month window, you should be able to get to the point where you have a robust structure where you can actually take that to market, and potentially building on some of the UIA work, accelerate some of that deployment of money into these projects and resource as well. I'm sure there's a huge amount of questions after that. It's much easier to do this in a sort of a bilateral format. So after Matt has gone through the UIA program, I'm happy to be grilled on all sorts of detail on that. Thank you.
Okay, I'm going to talk a little bit about a project that we are just finalising contracting recognition, which is a EU-funded urban innovation action project, so our timing is just spot on. That's roughly what I'm going to talk about. Do that, sorry. Firstly, as we all know with any project, particularly European projects, the acronym is important. So innovative financing and delivery of natural climate solutions in Greater Manchester. At the time I came up with this, I thought we need to put things like fire under this agenda, and then I thought, no, green infrastructure, we should be burning it. Carbon emissions, but they like the acronym. So just to give you a little bit of a run through of the project, and then what's in it, and then I'll relate it back a little bit to some of the stuff that Jamie's just gone through, and then we'll go into discussions. So it's actually a climate adaptation funding stream, so it's talking to sort of challenges that cities have, and this is without future projected climate change. The climate is changing, it's getting more extreme. 10 times more flooding incidents since the 50s, incidents of heat stress have doubled, natural capital, snowfall to stores water course things down. This stuff costs a lot of money. Boxing Day floods, about £12 million worth of infrastructure damage alone, thousands of properties, business and residential flooded. So people are seeing this stuff now, and we could build hard flood defences, cost a huge amount of money, and actually we get added value out of a nature-based approach. The suggestion is that just to hold the line in terms of water management and heat, we need to make outside there green walls, green roofs, suds, street trees, 10% more green, and we need to stop losing it. So that's the sort of scale. And when you're talking of the sort of scale of what is investable, you can't go to market and say, will you fund one Moorland school, which costs about 40,000, which was the BITC such, and then you go and fund another Moorland school, which costs 40,000. What we need to do is package these into something of scale and be able to deliver it if funders are going to help us with it. Europe have kindly given us £4 million worth of new money against our £1 million worth of cash and in-kind match. And what Ignition is going to do is it's going to work through that 10% green infrastructure increase. So where is it, what is it by 2038? So we actually understand the scale of the pipeline. We're then going to look at that overall pipeline and split it into these kind of investable chunks. So what is technically feasible, what is financially feasible. We're then going to spend a lot of time looking at the financing and business models required to deliver that. We saw or we heard about the SUDS model, the United Utilities banding charges. So how many projects could we get away through dropping a banding charge, bundling it together, borrowing money and paying it back through the band charge reduction over 10 years, 15 years, whatever it is. A lot of work on the capacity side of things, the governance, project delivery, contracting, funding of the actual final thing. So when we have our projects, when we have our finances, do we have the capacity to join those conversations up? If you think back to Jamie's diagram of the hourglass, you know, acting in that kind of pinch point space to really, really widen things out so that we can get projects away. And that will increase the investor confidence. And the final output of the Ignition project is that out of that 10% pipeline, we're going to identify something which is called phase 1. We're going to identify how we're going to fund it, where all the projects are. We're going to identify how we procure it, and then hopefully, the day after Ignition stops, someone signs a contract, and we actually have a sizable program of nature-based or natural capital investment ready to go. And just like any energy project or other infrastructure project, we have a PDU that does that verifies that the money's been spent, looks at what's been delivered, makes sure the returns happen, and manages delivery, and that again acts on investor confidence. I'll just go back. So, you know, this isn't kind of just a happy chance. The Natural Capital Investment Plan has been a long time in development. Environment Finance has been talking to us about investment readiness. If we actually sort of just think about what we've described and what we're hopefully being funded to test, you know, we've got the project pipeline, we've got the capacity that Jamie talked about in terms of the organisations to do that pipelining, to actually have those conversations with finances around business models. We've got a lot of money in terms of engagement and actually understanding how that is going to work. Ignition essentially is a little mini investment readiness fund around climate adaptation projects, and we're going to deploy that. It's going to help us develop a lot of the kind of governance and other structures that investors and others are going to need to see. And fundamentally, during the project, because we obviously need to get from phase 1 to phase 2 to phase 3 and deliver a whole host of programs and projects, and we need to be talking about more than just climate adaptation nature-based programs, we're going to run an investment readiness process within Ignition. So hopefully that will then enable us to draw down, you know, the next amount of capital to go back through the sausage machine and do it again. So that is where we are with Ignition. Just finishing off. If it works, we're going to sign some contracts. We've got a couple of months to sign the actual contract with Europe and all the partners, and then we start just after the Green Summit, don't we, Mark?
No problem.
And now that's Ignition in a nutshell, and I'm sure there'll be questions. Sorry.
Lovely, thank you.
Questions, sorry.
So don't go too far. I would like to give you the opportunity to ask questions of the speakers. I think that's right and fair. But I want to try and keep them to sort of a reasonable number, because I want your input. I need to pick your brains. And more importantly, I need to report those brains back. So, questions for either Jamie or Matt.
Hi, I'm Jess Thompson from City Trees. Thanks very much for those presentations, really interesting. I just wondered, there's a lot, obviously within Ignition, it's all very exciting, we're part of it around setting ourselves up, getting ready and so on and so forth. I'm just wondering, it seems to me that there's a massive chunk of work that's required to get investors on board. And we know it's massive, otherwise we would have been doing it years ago. So I suppose, what, is that a campaign, is it a marketing plan, what's the, how is, you know, it's all in the detail, isn't it? How does that actually happen?
That's for both of you, actually.
Yeah. Sort of dual.
Yeah. So within Ignition, there is resource tied to very specific kind of technical and expert things around, you know, the funding, the business models. But then there's also a substantial amount of resource around engagement. So we could have a programme of green roofs in Greater Manchester. We could find some funders. But if no building owners will actually let us put green roofs on because they're worried about structural stability, leaks, liability, access to other services, it doesn't matter if we've got a business model that works and we've got funders who are prepared to give us money. We can't guarantee the scale. There's too much risk that the finances won't put the funds in. So the thing that, one of the almost as important strands within the Ignition project is developing that market, is developing that demand, is ensuring certainty, so that when the more kind of technical finance stuff comes along and the technical nature-based, you know, can we store enough water projects come along, we can join it all up, and actually everyone will be happy that the money they're putting in, the sites they're putting in, the things that they procure will eventually pay back the loan. And that's Ignition focused, but hopefully that's a slightly wider model that you'd want to see again and again, regardless of the type of nature-based natural capital project you were interested in.
So, as I think some of the other speakers this morning sort of alluded to, you know, there's a huge amount of investment capital out there. Often people get stuck in the world of thinking about investment and the products you can do. That's not the difficult part. The difficult part is revenue and how you build robust business models and robust revenue models. That's the really difficult, complicated part. Hence the need of something like an IRF to kickstart that sort of that thinking. Once you have those business models and those revenue models, and you can sort of touch them and demonstrate to investors how they work, then actually investment is not hard. Actually, you know, you can aggregate if you understand that business model, you look at how you scale it up. The key thing is about understanding what is the risk behind that business model, what is the risk behind that revenue stream. Now, if it's guaranteed, well, where's my risk as an investor? But clearly, lots of these projects that we're looking at, and I think this is a really interesting thing around natural capital, because often you look at the economic value of natural assets. The economic value does not translate into monetary value or cash flow value. And from a financing perspective, you don't care about economic value, you care about cash flow value. And what I can build a cash flow forecast against. And it's that you can build a financing structure against.
Yes. Just an interesting sort of point really, or it is a question actually. The Investment Readiness Fund is not just a form of venture capital, and you're actually asking for venture capital for a venture capital fund with your first question.
So actually the thing about the Investment Readiness Fund is that you could call it an accelerator, you can rename it, and actually you don't even have to call it a fund. It's about deploying, it's not just about deploying money, it's about deploying skills. And you've got to figure out how you pay for those skills into very high risk activities, because clearly you're trying to come into a stage of a business where there's not necessarily any real demonstration of what that solid revenue model looks like. However, as we've seen through the Natural Capital Investment Plan, there are already some opportunities, such as the SUDS model, which actually could demonstrate really attractive investment cases, but they just need a bit more work to work through the difficulties. So it's not venture capital, because it's not about the end project, it's not about that. It's about sort of creating the business case behind it.
I'm Matthew Ellis from the Environment Agency. It's just a quick question around the social investment market. And I was thinking that the sort of key roles of government and their agencies have delivered. And I just wondered if you could perhaps reflect on which of those do you think are the kind of pivotal steps that you're perhaps focusing on now?
One of the first major steps was this sort of Future Builders program, actually, and that, by deploying over 100 million into a completely unknown market, which is massively at risk, was hugely innovative. That's really sort of putting your neck on the line in terms of taking a bet on a position. What that allowed to happen was organisations, in fact I'm sure Dan at Triodos benefited through that process in terms of how are you supporting the organisations and actually helping them develop their business models and grow. And it was that process that really sort of kick-started the market. At the point that, and during this journey as well, there was the unclaimed assets review, where all the sort of dormant bank accounts and people had died and their money had been left in many of the main high street banks. There was a big review that was done, and what that established was there was this sort of several billion pounds, which was legitimately public money, but it was sat in mainstream banks. And this review said, well, hang on a minute, why aren't we doing something with that? Now, instead of just giving it back to Treasury, very sort of innovatively, they said, well, why don't we set up a new type of institution, which led to Big Society Capital, which was the sort of the wholesale bank, the investment bank. And what that meant is that you then sort of pump primed your pipeline to opportunities that are being created, and then at the point that the opportunities need money, then you're starting to create investment opportunities to deploy that money into from Big Society Capital. And so whether it was sort of fortunate coincidence in terms of timing, or it was actually sort of well designed in that way, it'd be interesting to say. I know there's a lot of political arguments through the process, but that really, I think it was those two elements. So one of our questions is there's a huge amount of Section 106 money within the local authority. Is there a way that actually that could be mobilised in a way similar to Big Society Capital, that you can then start sort of putting together some pretty meaningful sums of wholesale money to deploy into the market?
It's worth saying that within Natural Capital Investment Plan, but also Readiness, there's a distinct work line to actually do some work on understanding what that was, and then how the lessons from the social side can actually kind of be what works, what doesn't work, and how it might sort of translate into the kind of natural capital side. So that's the kind of work strategy to try and take this into the next step for natural capital.
I think the key thing is, given the sort of the status of the market today, it is about deploying that sort of readiness funding to sort of push enterprises along the journey. Big Society Capital and organisations like that are really about pulling them because they, in theory, they're deploying their money into more sort of robust business cases.
Take one more.
Sorry, just following on from that, is there any indication from government that they would be interested in doing something similar to the social investment market to natural capital?
So environment finance with Vivid Economics, so economics consultancy, environmental economics consultancy, they did a lot of the business case behind the Green Investment Bank with McKinsey. We've been working with them, and we did a project for DEFRA to look at creating a natural capital investment fund, impact fund, mentioned in the 25-year plan. It's a question to government at the moment. You know, it's literally going to ministers, but we think there's a massive demand. Actually, if you think about the political context, what's happening in the UK at the moment, this could be pretty important. So we think there's a good opportunity. We see the demand from our clients every day, and you know, we need more organisations, a bit like Environment Finance, sort of supporting all these groups to sort of upskill them.
That's one.
Dan from Journals. Yeah. I'm just wondering, in the Investment Readiness Fund, are you thinking about it as a grant fund that would grant out to provide investment readiness support, or are you thinking of it as actually an investment fund?
So I think the capital needs to be very flexible. So where you have robust business models, you know, if there is a robust business model that you can see a return against, I don't think you should be giving money away. I think where possible, you should be looking to attract some sort of return, whether that's a revenue share model or there is some sort of fixed repayment on a future capital raise, a bit like the ICRF program. So I think it's about having the most flexible capital as possible, which probably will be grant funding, but the fund will be sort of geared towards trying to generate enough surplus that it can run itself. And I think that's the key point, that you don't want it just to be funding sort of loss leaders. It needs to be funding activities which do demonstrate a return opportunity.
I think I'm right in saying that the initial project provides some of that capacity that's required to help set up the investment readiness fund, that's skills and investing. But also, whilst there's a work stream particularly looking at stable development based on work that's done by the ITC, and that could be more performance, the primacy within the initial project is to look at developing those other business models to try and answer some of those questions, which I think, if we're honest, we don't fully have the answer to yet.
Yes, so Ignition needs an investment readiness process, or whatever you call it, at some point, because it's providing technical assistance around some things that are reasonably near to investable, the kind of SUDS charging. But if you think about that 10%, 20-year urban green infrastructure pipeline or other types of projects, if you don't build in that kind of future capacity to keep developing the projects and capacity to deliver them, and the finance models and the contracting, Ignition will stop, and it will stop. So actually, a wider kind of process of getting technical assistance in whatever form needs to be part of Ignition if we're going to prove that, to Europe particularly, that there's a kind of recycling sustainable model. So it was always built in as a need, and actually it just perfectly fits in with the Natural Capital Investment Plan, wanting to do the same thing as well.
Can I turn that around? If you don't mind, I'll put you on the spot. But that sort of asks this question, or answers this question. So who needs to be involved in the investment readiness fund that we described, and potentially the setup and governance arrangements? What might that look like? Do you have a view?
Is that to me?
Yeah.
Oh, okay, sorry. Yeah, I think you obviously need a panel on that fund to evaluate any applications that come through. And probably, depending on who's funded the fund itself, if Greater Manchester's put some money in, there probably should be somebody from Greater Manchester on that panel. You probably then need somebody with a commercial background to look at that proposition as well, because if you're granting money out to a project, you ultimately want it to become investable. So it'd be something like a Jamie on that panel. So I think maybe a bit of a mix of skills there, so that people have funded the fund, plus somebody with commercial expertise to evaluate any application coming forward. I also think you probably need a panel of approved advisors that the applicants can, because I mean, say I was a chief executive of Wildlife Trust and I wanted to apply some money to the fund, I might want to recruit somebody who's going to help me develop some tourist facilities and I might want a grant of £100,000 to pay for them for 2 years. So I'm not necessarily looking for investment money at the moment because I'm pre-investment. I'm trying to develop a facility, but I haven't got the funds in my own NGO, my own balance sheet to fund what I need to do to become investment ready. So there's a bit of a question about, what is the fund for? And obviously what I'm looking at for there is a grant, really, so I can scale up my business to become investment ready over 2 years. So I think the panel of the fund will be looking at that, saying, okay, we initially thought this money would sort of go to financial advisors and lawyers, but actually, maybe a lot of the funding is required to upskill some of the organisations and allow them to bring some commercial expertise in. Because actually, until you've got the business model that's investable, you can do all the financial modelling and the like. But, so there's a bit of a question about exactly what, around the governance, and also what are the criteria for actually accessing the money.
The criteria is, well, yes, evaluate investee projects. So I think we'll come back to that in a second. Would you like to come in?
Yeah, so Emma and I strongly until last year working for the Green Investment Bank. One of the key things that's really important, I think, is the level of risk appetite and transparency of the level of risk appetite that the organisation is going to have. So one of the big things that we came up against at the Green Investment Bank was that the vast majority of people seem to think that we invested in low returns, high risk projects, and we were completely the opposite. We had an IRR of 10% on our projects. We only invested in low risk projects because we have taxpayer money. And if you have taxpayer money and you are not clear on what you're trying to do, what you're trying to achieve, we had a mandate where we had to have a profitable green institution. You cannot then invest in high risk projects because you're throwing taxpayer money down, potentially throwing taxpayer money down the drain. So being really, really clear on what the level of risk appetite needs to be for the governance structure of the IRM is really, really, really important.
And also, I think you had a challenge because you weren't allowed to compete with commercial banks. We had to compete on the same level as...
Yeah, pari passu basis. So we had to go in exactly the same commercial terms as co-investors. But a couple of the ways that we measured the success of the Green Investment Bank was leverage. So for every £1 we invested, we wanted another £4 coming from the private sector. And the other one was we actually measured the number of private sector co-investors that came in alongside us. And some of our most successful projects were actually our smallest ones, where they had like 16 private sector co-investors with us, which then became really interesting, and it's a really good story to be able to tell.
Thank you. There's a question here. Yes?
It was just to add on to the thoughts about governance and support infrastructure around the IRF. I think, because it's essentially about natural capital investment, we need to make sure that there's technical support to the organisations around demonstrating the impact and the value of natural capital, but also that appears in the governance as well, so that the impact of the overall fund in the round can be understood.
Okay. Any other comments on, well, we started on governance, let's stick with governance, or who else should be involved in the IRF setup? Explored that one. So let's move on to evaluate investor projects. So I think we've just started talking about criteria. What other criteria should we have placed on investee projects?
So upstream from that question, I just wonder how you're going to identify or attract investee projects.
So, do you want to answer that? Shall I go?
You can have a go. Because it is wider than just Ignition. This is the whole natural capital investment plan.
So Ignition particularly focuses on climate change adaptation, but the natural capital investment plan is broader in its context. And from my perspective, I cover the broader environment agenda, so I would start thinking about investment for things like fuel poverty or reduction in carbon emissions. And I think that's a little bit further on. So my answer would be, within parts of the Ignition project, they have an understanding of where some of the first run-up projects might be, and the natural capital plan adds on to that and talks not just about sustainable urban drainage, but starts talking about habitat and carbon banking and potentially a trustee model. All of those things could be investigated, and each of them would potentially have identified sites that would go with it. Some of those sites have already been identified, so some work has been done to try and identify some sites. Some will have to be identified as part of that ongoing process. The people we've got involved with the Ignition project are exactly the same sort of organisations that are on the ground and would be able to identify projects of that type. So BITC is a conglomeration of business organisations, City of Trees, Environment Agency, the universities, the research side of things. There's a few I've forgotten. Also forgotten. Groundwork. So it's the whole of groundwork, isn't it? It's Manchester, Tameside, Salford, and so on. So I think there's a wealth of knowledge within the group that can help to try and identify the projects. The real question for me is, how do you get that return, or how do you get a sufficient return on investment to make it an attractive proposition and still be able to draw out ongoing revenue costs to be able to support the finance of the process? That's where I'm fine with Ignition because it gives you some funding from Europe to do that in the first couple of years. And if you like, they're taking the risk, or we're taking the risk. But after that, you have to have self-financing.
So
and
is
that's
the
relative.
IRF just looking at adaptation projects at the beginning, or is it your whole
It could be an awful lot wider, but the Ignition project is focused on those which are climate change related, and so we'll start with those. The natural capital plan that you've seen will look at the broader spread.
It's worth saying, when the Ignition project does an investment readiness type process, it will be a bigger picture. Because if you're trying to present a sustainable replica model back to Europe or other cities, telling them that you've done a nice climate adaptation investment readiness process, but they might want to do another one for all the other projects. So actually it's all about governance and process. So when we look at investment readiness, we'll want to look at it in the round, because why would Mark run two? Why would GMCA fund the resource two? Why would it govern two? And what you can do is you can look at the big picture, and then if Ignition has some later phase adaptation projects, investment readiness can just come in and support them. Or if it's upland carbon sequestration, it can look at them. So hopefully it's the full picture, because otherwise, it's not what cities are going to want to do if they're ever going to replicate this.
I think what also I would say is Greater Manchester has quite a lot of experience of investable propositions, investment funds, recycling of those funds. Not necessarily in this space, but in other capital infrastructure type projects. And so we don't come at this from a blank piece of paper, but this is almost like an adjunct. It's another wing to investment that I don't think we have done before. So it's about getting that learning across the whole, so that we start to build this into the mainstream. It doesn't become a niche thing over here, but it becomes part of the way Greater Manchester sees itself investing in the
future. It's obviously called the Investment Readiness Fund in Greater Manchester, which has a political boundary, but the system, the natural system, doesn't operate on political boundaries. So I was wondering if the Greater Manchester Investment Readiness Fund would consider projects outside of the political boundary.
Initially, I would say no, because I think we've got enough to do ourselves. Having said that, if a really good project came onto the boundary of Greater Manchester and had benefits within Greater Manchester, then I would see that would be within scope.
I was particularly thinking around the headline statements you made about flood.
So you're talking catchment-based approach, yes, I agree. So if that's what you're thinking, I think natural biological systems, you'd be silly not to take those into account. But would we invest in something bright? Probably not.
So going back to the evaluation of the projects question, so I think it would be really important to have a kind of multidisciplinary kind of take to that, because I don't think there's one discipline or one set of experts that are going to be able to answer all of the different types of criteria, the different types of impacts that you're going to need to be able to capture or evaluate. So, you're going to need the kind of corporate finance side, you're going to need the kind of cost-benefit analysis or kind of more standard appraisal experts, but then you're also going to need the more alternative or the kind of newer evaluation methods or approaches, so things like natural capital but also social value, to bring a more kind of holistic picture to it. So I think definitely understanding that it's going to be bringing different types of disciplines together and they're going to have to work together perhaps to do that is quite important.
Okay, thank you.
I might suggest in terms of evaluation that it's quite important to come up with an evaluation methodology that doesn't cost the earth. Because if it costs the earth, you will not be able to afford to do it. It won't be an investable project just because it will cost too much to evaluate it.
And is the same true for verification?
Potentially, yes. Although if you have a system that is, well, the way that we did it was we had verification of the process that we used rather than verification of every single underlying project. So we would just do a standard audit approach where they would take a selection of projects and check that we had evaluated them to the methodology that we had designed. The methodology that we designed, we then we basically socialise that with a whole load of stakeholders, NGOs, consultants, and various others at the very start. So we got verification of the process, so to speak, through a process of engaging with stakeholders, and then we got full-on, PwC style audit and evaluation of the way that we employed that process, and the fact that we were actually employing the process that we actually did in the way that we said that we were. That it was very much about keeping costs down all the time, because that is
killer.
Yeah.
Okay, good. Simon?
I suppose it's a question around governance, but how you get the balance right between the cash flow, investable projects, and also inequality in terms of assuming this region like ours, there'll be some bits where the land value is high, it will make good projects to invest in terms of enhanced value for developers, the rest of it, and there'll be some projects that the land value is poor, the area is poor. So I suppose it's just a question about getting that balance right of cash flow, good projects, but also making sure the inequality issues dealt with.
Another answer to that?
I was just going to say, I totally agree, and I think it goes back to the importance of a theory of change and having a really robust sort of view, a broad view of the sort of what is the impact that this is trying to achieve, and that needs to be sort of clearly quite broad and set at the beginning. And I think this goes back to who should be involved at the outset in terms of setting this up and setting that, what those outcomes look like for the project. Because if you don't set that at the beginning, it's very hard to engineer it in later on.
You get a bit of that with the governance. So if you were looking at 106 or biodiversity offsetting from high value areas or areas where damage was happening, you could look at where you were going to spend that. And similarly, the sludge water charge issue. Some properties are really near the band and they're quite high and they're going to make a massive saving and it will pay back within 5 years. But if you did it at a programmatic level, you could go and invest in less sort of financially viable ones, but still offer the investee whatever level of return and kind of spread your intervention over a more diverse and useful kind of hot project.
Just to add to that, I guess on a practical note, I think what we see on a sort of actual investment level, at a project level, is that quite often there's no silver bullet to make the business models work. And you end up sort of stacking lots of different income streams together, or a few major ones. Actually, where you are working in areas where there is potentially deprivation issues or sort of health benefits from the project, that actually opens up the opportunity to stack other income streams in beyond just the sort of more conservation benefit out of the project. So actually, potentially, you can actually have projects that fit very neatly into sort of deprived areas because of the sort of devolved health budget opportunities.
Okay, I want to move on to the final question, which was around the role GMCA should take. Within the National Capital Investment Plan, it is suggested that the GMCA should be an investment commissioner. So almost acting on behalf of the public sector to help identify projects and almost take a part in the governance and take a part in the acceleration process, but potentially do that from an arm's length point of view, so to avoid any conflicts of interest. Does anybody have a view on that? I have to say the GMCA hasn't yet agreed to that. I'll put it to them. I'm hoping they might.
Sorry, I'm conscious. I actually do agree with that. I think the arm's length one is quite important. One of the things that I would suggest is GMCA is really well positioned to both encourage and incentivise projects to take a revenue-based approach from the outset. So if you can switch it around so that people think revenue first, and if they then can't find the revenue streams, then they go for grant funding. If GMCA can be the organisation that kind of changes that language and changes the approach of projects, that would be a really valuable piece of work that GMCA could lead on, is getting organisations to think revenue first, and if you can't find a revenue model, then you try and go for grant funding.
Yeah.
But basically projects that can pay for themselves do, if you don't waste public money effectively on projects that can pay for themselves.
And that fits into the criteria assessment as well.
Yeah.
Anybody else have a view on this?
I wonder that you might get too involved all the way through. You might end up basically setting this fund up, funding it, sitting on the panel that reviews applications. Then you might end up being an investor, and then you might end up being on board of the companies. So you don't really want to. Do you really want to do what's question with it? Do you really want to do everything, or is your role more the front end actually, setting the fund up, providing some funding, getting on the panel, and then let the organisations. So you're evaluating a successful application, but then you let the market decide how it's funded.
I think that would probably be my preferred model. I think there is, just being straight, I think there's a limited amount of funding the GMCA itself could put in, but we might be able to figure out how finance could come from other sources to get a seed corn pot going, because we're subject to all the constraints that local authorities are under. But also it might be, and I'm not prejudging this, but some of the assets that we're talking about might be held on local authority land, which puts us in direct conflict of interest. So actually having an arm's length relationship where we help do some of the facilitation at the beginning to get something set up and then almost hand it over for it to be continued feels like the right sort of approach to me.
Could you not perform more of a broker? Obviously, as the recent, there must be billions washing around green funds, especially with the divestment. It's just kind of a hand over fist. So it's more of a broker role to attract green funds into Manchester and pair them up with projects.
Yeah, we should note that. I think it's, for me, it's about creating investable propositions.
Yeah. So, just, we've been, in the West Midlands, we've been talking to some US sort of state level green banks, and it's quite an interesting model there with their version of a local authority set up an arm's length body, independent, and they're a partner, but the role they do is create the market. They set local planning policies which generate a demand, which then the bank helps meet. So it's more of an arm's length, but actually the local authority has a key market making role, if that makes sense.
It does, and that's sort of, it didn't really come out earlier, so we could talk a little bit about the spatial framework, which is out for consultation. It was launched on the 7th of January, and within it there are policies which require or at least incentivise carbon offsetting and potentially habitat banking. So I think we've started to think down that route. But of course it's still subject to consultation, so until the final thing's confirmed. I'm going to have to draw us to a close, or you're going to miss your lunch. I'm really sorry. So, hi, Joe.
Hi. Just a comment, Mark, on your first one about potential sources of co-funding.
Yes, please.
I think we've got a really good opportunity in Greater Manchester to look at our financial heavyweights here we've got here already. So if you talk to the likes of the large solicitors such as Adelshaw Goddard, they have charitable trust funds. They have, I think we should really involve them in that, even if companies such as Investec in Greater Manchester, they may well have private clients who would be really, really interested as local people investing in Greater Manchester into this package.
Okay, thank you.
It's the language again, it's bringing the two worlds together really.
Yeah, okay.
Can I just add though that I totally agree with all that, but I do think it'd be great to have the GMCA supporting that as a broker. Otherwise we are as individual organisations still sort of bashing our heads against the wall, trying to break into, as a collective, because it requires a whole culture change, doesn't it, across so many disciplines. Actually, the GMCA has a really good role in that.
Okay, that's really useful feedback. Any last comments on point 1, potential sources of co-funding? Any final comments? Okay, so can I thank you very much for your input. If anybody in the room wants to come and have a quiet word in public, particularly if you want to be involved in this in the future and you've got something to contribute, then please do. Either myself or Mark will be around for about 10 minutes or so. Please go and have a great lunch, and the next piece is back in the main auditorium at 1:15, which gives you 25 minutes. Thank you.